Welcome to the HC Insider Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. Today, we're going to talk about the coming commodity supercycle. Our guest is Jeff Currie, Global Head of Commodities Research at Goldman Sachs. An industry veteran, Jeff oversees research across all of the commodity verticals from ags, metals to energy. Jeff, thanks for joining us.
Great. Thanks for having me.
I guess the public statements, beginning of the year, the view is that we're entering another commodity supercycle. Before we jump into kind of why that is, can you help us understand what a commodity supercycle is, how often they happen, what defines them? Help orientate us to that.
Well, I think it's a combination of a structural rise in demand and combined with inadequate supply such that prices reach previous peaks, and they do that on a sustainable basis until you get the investment into the sector to rebuild the supply base. And when we think about commodity supercycles in the last 100 years, we had one following the Second World War, and you had to go back and rebuild a lot of commodity productive capacity, and you needed higher prices to achieve that. Another one in the 70s, and another one in the 2000s. And those periods last somewhere around, I would say, 10 plus years, because that's about how long it takes to invest in new productive capacity. So think about it as being an investment phase, to invest in adequate supplies to be able to meet a rise in demand. But one thing when I look back at it, they are also characterized by periods of redistribution. And you think about, that period in the 70s, it was characterized by the war on poverty. The one in the 2000s was essentially the rise of the middle class in China, which was redistribution between European and American middle class, towards the lower income of China. So these redistribution themes are also very important and play an important role in these commodity supercycles.
Yeah. Before we jump into why, the thesis of why we're about to enter a new one, so when was the trough of the last one?
The trough of the last commodity supercycle was in late 2015, early 16, when oil reached $25 a barrel because of two factors. One, we finally saw the enormous supply response due from the $147 oil during that supercycle. We also saw the end of that structural rise in demand from China, meaning that you had returns in China were finally turning negative. The pollution was at intolerable levels. And when we think about the ability to go forward, it had to become from restructuring, deleveraging too much debt, taking the pollution out of the system, and cleaning up excess capacity to get returns better. And that's what they did in that previous 5-year plan, was to make those types of restructurings to be in a much better position, which is where they are.
How much was the heat taken out of the last cycle as a result of the global financial crisis, increased regulation in commodity trading across the globe?
Very little. In fact, when we look at the financial crisis, it's a blip in the chart of commodity prices marching higher from essentially January 2002 following September 11th, all the way to, you look at the peak in commodity prices, it was sometime in the second quarter of 2011. Yeah, technically the oil price spike in July of 2008 was higher, but you look at back-end oil and you still had $130 oil in April of 2011. So you look at all these markets, they capitulated sometime around 2011. I also like to point out it was also that same time period in late or spring of 2011 that Glencore did its IPO.
So I know these things are really hard to actually pinpoint when, but the thesis is that we're at the beginning or in the early stages of another commodity supercycle, and your thesis in particular is REV, R-E-V. I'm fascinated by this. Can you walk us through why you think we're at the start of the next supercycle?
The core of it is the pandemic represents a structural shift that creates the catalyst for the structural bull market. And the reason I say that is following the financial crisis in 08-09, policy was focused on financial stability. And so every time anything got very good, they would raise rates or push the market back to some equilibrium. And every time anything got any really bad, they would stimulate to get the market back to equilibrium. It didn't matter if it was OPEC, who had a policy of market stability, or the Federal Reserve that was focused on financial stability. All policymakers were focused on that stability, given the trauma that occurred after 08, 09. Now, we have a period of we'll call it a social crisis. You can argue that COVID started out as a health crisis, morphed into an economic crisis, and now is a social crisis. And to deal with a social crisis, policy needs to be focused on social need. And when we think about social need, it is a radical shift from where we were in the previous 15 years. Because think about this. If your problem was fixing a financial crisis, your stimulus mainly went on bank balance sheets to plug non-performing loans, which then in turn drove down interest rates, mechanically raised equity prices, and created a wealth effect. And we ask, who owns most of the world's wealth? It's the higher income, richer people in the world. So they were the ones that benefited mostly from this stimulus, and their marginal propensity to consume is very low. You give them $1, they're going to save it. They're not going to spend it. When policy is focused on social need, it goes to the lower incomes. And the lower incomes have a high propensity to consume. And as a result, when you have stimulus directed to those income groups, it systematically raises demand. We didn't get that out of the financial crisis. And that's part of the reason we never saw inflation and we never saw a commodity bull market, is we didn't get that environment of a mechanical increase in demand from the stimulus. This time we're getting it. In fact, you can already see it in the postcode level data in the United States, where the lower incomes are consuming at a much higher rate than what they were previously. And so that really sits at the core of the structural change, is that we're now focused on policy that is aimed at social need. Now, there's three components of this. One are just outright redistributional policies. The second are environmental policies. Think about that as being green capex. And then the third are versatility and supply chains, and those are REV. So R, redistributional, E is environmental, V is versatility and supply chains. And just, redistributional, it is what it is. You're just basically redistributing wealth towards lower income households that have the higher propensity to consume, to deal with income inequality.
Just staying on redistribution before we move on to the other two. Is that a global phenomenon? Are we seeing that, beyond just even Europe and the US, in the form of these direct stimulus checks, in form of, various policies? Is that a global phenomenon?
It is in the 5-year plan in China. You take that dual circulation. It's creating domestic demand for their own output, so they don't have to rely on the Americans or the Europeans for consumption of their excess production. And to do that, they're going to move people from the rural areas into the urban areas. And so again, it's this same concept of stimulating activity at the lower income level to create new demand for their own products. So this is something we've never seen before, in that China, Europe, and the US are all focused on these redistributional policies. The other thing with China to keep in mind, they're fully aware of what's going on in the US and Europe with extreme income inequality. So they're doing everything they can to prevent that from happening, which is keep continuing these policies focused on moving rural people into urban areas and creating that uptick for the lower income groups. So no, this is very much a global phenomenon and not isolated to the US and Europe. However, I do want to emphasize that in US and Europe, it's at a high pitch where it needs to be dealt with in the current environment, which is different from China. China doesn't have to deal with it right now, even though they are focused on it. US and Europe have to deal with it. And I'd argue the problem in US and Europe, now I'm not going to say it's a direct result of what happened in China in the 2000s, but it exacerbated a problem that was already underway going back to the 80s. In fact, I want to make this point, is that if you look at income inequality and you look at it over the last 100 years, When was the US and Europe the most equal? The answer is 1979, which is a period of peak real commodity prices and peak inflation. So solving income inequality is usually associated with commodity bull markets and inflationary pressures. It goes back to this whole point. You're creating new consumption, which is what China did in the 2000s, is continuing to do now, and what Europe and the United States are likely to do.
And arguably, this time it could be an order of magnitude greater than in historical examples. This is a week when GM have announced a production interruption because they've run out of, chips, microchips. Just, I think, a small microcosm of kind of this huge demand and actually challenges around actually meeting that from whether it's supply chain of finished products or the commodities themselves.
Absolutely. I think that is a critical point, is that we haven't seen this type of demand growth in decades. You look at durable goods demand in October of last year in the United States, it was running at 15% year over year. And by the way, there's no COVID effect October over October of 2020, which just underscores the type of demand strength that these industries are facing for the first time in a very long period of time.
Yeah. And then you've got these other two legs to the stool that are part of in some cases, used part of the solution, and in other cases, part of the drivers to what's going on that redistribution. Can we move on to, I guess, environment, the E in REV?
It blurs between E and R. And I like to borrow the term from Boris Johnson, green leveling, spending on green capex to level income. They solve, you kill two birds with one stone, in the sense that climate change is a pressing social issue. And income inequality is one as well. So you can work at solving both at the same time. In terms of thinking about the amount of capex that we see happening, we would peg it at around $16 trillion over this coming decade. To put that in context, the Chinese spent about 10 trillion in the 2000s. Put that in real terms, it's pretty much close to the same. So this is about the same magnitude as the capex cycle that China created in that BRICS boom or EM boom of the 2000s. And again, you can draw parallels to the 70s as well. While we had the war on poverty in the 70s and we have the war on income inequality today, you also had the war on acid rain in the 1970s, and we have the war on climate change. By the way, taking the sulfur out of the fuels and out of the atmosphere accelerated the carbon problem. Think about this. Sulfur is a coolant, and we didn't like smog, but smog did cool the Earth's surface. By getting rid of smog and getting rid of all that sulfur, we actually heated the planet. In fact, MIT just did this study that estimates IMO 2020, the final nail in the coffin of acid rain, raised temperatures by 1/4 degree Celsius. Sulfur, you take one out, you create, you accentuate a problem. It's a delicate balance. So that war on acid rain helping, accentuate this war on climate change, and we're going to deal with this and probably create a problem down the road in the future when we deal with this. But I think the key point here is, again, those parallels with the 70s with today is, today it's the war on climate change. And then I think, if anything, COVID has shown us is that these problems are probably worse than what we think, and that this spending is going to, most likely accelerate going forward. And that 16 trillion is based upon where we see costs today. They could be substantially higher when we actually see it. One last point on the E before we move on it is that today is very different than where we were 6 weeks ago. With Biden in the White House, Georgia having gone Democratic, the probability of seeing a sweeping climate change type bill being pushed through is very high. We have a blueprint in the US now for what energy transition looks like. We already had one in Europe, but more importantly, as soon as Georgia went Democratic, the Chinese responded and had their own blueprint for energy transition. Why? Because they knew it was a high probability that the Americans were going to join the Europeans and hit them with a carbon border tax. So if anything, right now, if we take, like, we had a Cold War and with the Soviets back in the 70s and a Cold War today, instead of an arms race, we probably have a decarbonization race to, who's going to get hit first with a carbon border tax. So if anything, it kind of works in the favor of trying to resolve this. But I think the key point here is that we now have a blueprint for what energy transition looks like globally. We didn't have that 6 weeks ago.
And there's a couple of points I want to dig in there because I know from our previous discussions that, using that analogy of sulfur, that really took the Russians and the US coming together, the two biggest manufacturers of timber, to solve that issue because it had direct economic impacts on them, and they were the ones that could move the needle. Are you suggesting, or the thesis is that actually, because one of the issues about climate change has been, getting now the Europeans, the US, and the Chinese, and even the Indians on board, have we kind of gotten past that stage now? Is there that global alignment that this is something that needs tackling?
Yeah, and I think the threat that did it, the equivalent to the lumber industry of the 70s, is the carbon border tax, the trade war. Because the trade war was already in place, the obvious next direction the trade war was going to go was carbon border taxes. And if you knew that was coming your direction, you're now China, you want to get in front of it. Yeah, I argue, why did Xi Jinping get so green on us after Georgia? I would argue it's that.
And that's going to take us on to the V. But before we get there, have the US, has Europe chosen? And that, in terms of particularly transportation, are we just going to go straight EV, the household level, hydrogen or whatever? Have we gotten past what technologies we think the future is going to use? Are we there yet? Or is there still quite a lot of ambiguity, uncertainty about how that decarbonization plan will play out in our daily lives?
Before COVID, I thought there was a high probability we get this perfect world where a functioning carbon price that's global in nature, people could invest around it to find the optimal technology to solve this problem. COVID came along, and it changed all that. It means you have a public-private partnership to try to solve these problems. Governments are going to pick the technologies and spend money because now you're killing two birds with one stone. You're killing the income inequality issue with the green agenda. And so to do that, you actually have to pick the technology to try to solve this. And in doing so, you take away that free market aspect of the market choosing the technology. So given that, we think, okay, what are the technologies most likely? And the Chinese are very explicit in their most recent description of how energy transition occurs is it's renewables. And you use gas to deal with the intermittency because in the future you can switch the gas infrastructure to hydrogen. And then you deal with the industry with gas today because you switch it to hydrogen. So that hydrogen becomes the ultimate fuel, but you build the infrastructure around gas because they're dual. And then batteries and hydrogen become the transportation fuels. That's kind of the direction in which the Chinese went, and the Europeans are potentially going there, and same thing with the Americans. Now there obviously can be variations of that, but that does seem to be the direction that they're going. And what that news is, it tells you which commodities are going to be the ones that are going to be high in demand. And obviously copper sits atop of that list because electrification sits at the center of it.
Yeah, and we've talked a lot about hydrogen on this podcast. Okay, so before we move on to the impacts and the ramifications of all of this, the exciting bit, let's just zoom in on that V, that versatility of supply chain. So you've already touched on carbon becoming the next sort of tariff. Can you talk about that the V and why that's going to drive a commodity supercycle?
It's because you have a quasi Cold War between the West and China. And obviously the trade war was the first manifestation of that. And in the trade war, it was building out your own manufacturing sector, securing supply chains. You look at the Chinese dual circulation. Dual circulation means creating demand for your own output, but also securing the inputs to your own output. And so that would be like, the Chinese building reserves of grains, building reserves of copper, building reserves of oil. By the way, the Europeans and the Americans did this in the 70s during the Cold War with the Soviets. So we're seeing a very similar dynamic playing out again. But it's not only just securing, supply and security of supply through reserve building, but it's also Biden's Made in America pledge. Biden wants to buy EVs that are not only made in America, but made with unionized labor. To do any of that, you've got to build out new supply chains. So it's going to create a new demand, or it's the duplicate 5G networks that are likely to be built. So all of this, it's a resiliency in supply chain that we saw during the 70s, during that Cold War with the Soviets, we're starting to rear its head again. I don't think you're going to get that type of capex that was associated with that arms race, which was massive in its own right. But you're also going to get a lot of capex for things like, let's say, duplicate 5G networks to avoid having the Americans doing Huawei and using AT&T instead. So those are going to be the type of dynamics that we are referring to when we think about this versatility and supply chain initiatives. But you're already seeing it in the reserve building within China.
Hmm. So I think it's a pretty compelling argument. We're already seeing it, as you say, here in the US and globally in prices. Is there anything that you think can happen that would stop it dead in its tracks that still sits within the sort of realm of feasible and possible?
You know, it's all about execution risk of the policymakers because it is a political view here. There is no natural arbitrage to force this in the sense that, let's take China. China was a policy decision. When you look at when was China admitted into the WTO, it's like September 17th, 2001, right after September 11th, 2001. Why? Because the Americans needed the Chinese to vote to allow them to use force in the Middle East in the UN Security Council. So they swapped a vote in the UN Security Council for an immediate admission into the WTO. I don't think they ever thought the huge implications of doing that. But what it did is it opened up an arbitrage between Europe and the US and China through the exportation of all these goods to arb that labor differential, the pollution differential, and the cost of coal differential. So it had a natural arbitrage. Here we don't have that natural arbitrage. The arbitrage has to be created by government regulation. So the government, spending on redistribution, spending on, environmental green initiatives. So the question is, are they going to back off? Now, I do think there is a natural arbitrage to it in the sense that if you look at the 70s, once you open up that Pandora's box, putting it back in is very difficult. And the reason I say that is you look at LBJ. He was the first one that did the war on poverty, but clearly Nixon continued it, Ford continued it, Carter continued it. They didn't put that genie back in the bottle until 1979, and then finally Reagan put the nail in the coffin of it in 1981. So it was a long road. So once you do this, it's difficult to put it back in. And here's a very important point. You take what was one of the biggest risks to this view, late last year, it was that McConnell in the Senate would stop it. Well, he didn't give the $2,000 checks, and what happened? He lost his job after Georgia. So I would tend to think that that this genie is out of the bottle, and if the policymakers don't respond to it, it becomes increasingly difficult of an environment to navigate. So I think there is somewhat of a natural arbitrage like what you had with China in the 2000s, but it's not nearly as strong.
Yeah, and also it's a bit of a self-fulfilling prophecy, as we'll come on to it later. But obviously inflation driving prices itself. So our audience is primarily in and around the commodity trading world. So with that lens on, what do you think the short-term impacts of us entering a commodity supercycle will be? The next 1 to 3 years, or whatever we define as short-term.
The question is, are we in one right now? I would tend to think that we are. And the reason I say that is that if you look at these commodity markets, every single one of them, with the exception of zinc and cocoa, are in a deficit right now. And only oil has the artificially curtailed supply due to OPEC. The rest of them are in a natural deficit, which tells you that the underinvestment in supply has already started to bite, due to what we call the revenge of the old economy, meaning that, due to higher returns in the new economy, capital was redirected towards the tech boom, starving the old economy of the capital that need to build the supply base. Overlay negative oil prices from COVID and ESG factors. In oil, capex is down somewhere between 40 and 70%, depending on where you are in the world. Capex in metals and mining, no maintenance capex is going on due to delays around COVID, on top of a lack of investment that had been going on since 2013. So, again, it's a very tight supply situation that is creating these deficits right now. So I'd argue it's already underway. But immediately, there's also this macro repricing due to a weak dollar that could take us to much higher levels in a very, very, very quick period. I don't know when these macro repricings occur, but I've lived through two of them in my life, one in 2005 and another one in 2015. And, to give you an idea, I talk to people who are oil people, and they go, why are you talking about iron ore when you're talking about oil? Because you got to look at these in a very holistic manner. And the reason I say that is I'm going to give you an example of a Canadian, private equity firm that had oil assets back in 2012. They valued the assets at $120 a barrel, and the IRR of the assets was running around 20%. Fast forward to 2016, oil goes from 120 down to 45. Iron ore goes from 182 down to $30 a ton. Copper goes from 9,000 a ton down to 3,500 a ton. The Canadian dollar gets smashed from 1.4 down to 1.9. The dollar rips to the upside, and we wake up in an entirely different world. So now let's go back and revalue that Canadian asset, $45 oil. What do you think the IRR was? Because remember, the Canadian dollar are wages. They've been smashed. All the steel, all the input is at different price levels. The IRR was 21 to 22%. It was higher at $45 oil, which underscores that when you go through with these macro repricings, they're not really fundamentally driven by the fundamentals of the commodity market. They're a much broader dynamic. And actually, it's a good thing. Remember when you asked me at the beginning, when was the trough of the last commodity super cycle? It was exactly that macro repricing. Why? Because the first macro repricing that I lived through was '05. They all went to China. They believed in the China story. Oil levitated by $20 a barrel as they believed in it. And it was in 2015, they go, nope, game over. Remember, it was Uber and it was the unicorns in Silicon Valley and all of that tech boom. And that's when the fangs took off. Netflix and Facebook, all that money came flying in. It was Uber was the poster child. And it all went into the US.
We haven't seen that pricing shift yet, though, have we? We haven't seen that.
Haven't at all. And when that pricing shift happens, it's going to be violent. And it'll likely be the obvious place for it to go is into real assets, which would be oil and commodities and everything. And then you reprice everything. I don't know where oil goes. I just tell people I want to be long and hang on for the ride because I don't know where the next stop is. And I don't know where it is on any of these markets.
So when we go back to 2005, at that point, I remember I was starting my career in searching commodities. Everyone was getting in. There was a huge, the returns from trading houses, banks, merchants. It was, it was very famous back then. It was kind of, I remember the Financial Times article that if you could spell derivatives, you could, have a lucrative career in commodities. Do we expect to see that again? And I also want you to bring in, at the same time, there was a huge amount of passive investment started to come in with the launch of the GSCI and so forth. What is this going to mean for the trading environment?
I think it's going to, absolutely explode. And here's the reason why, is that if you look at the size of bond portfolios today, they are unprecedentedly big because of QE. Far bigger than in '05, far bigger than in '08. That's all that we've seen grow and grow in extraordinarily large size over the last 10 years. Yields are incredibly low. They've dropped on your average investment grade portfolio has a yield of 1.95%. Put in your government bonds that are 0 to negative, and even high yield comes in at 2.8 now. My guess is the average bond yield's got a 0.5% yield or something like that, or maybe 1%. And then you go, okay, now let's let inflation start to drift from 1.5 up towards 2, maybe 2.5. What if it goes to 3? These bond portfolios are massively underwater. And then you have to go, okay, they need to hedge. They can't all run out the door immediately because then, interest rates are going to explode. So essentially, they're going to have to turn to something to hedge. What is that going to be? It's got to be a real asset. And oil companies won't do it. A REIT I mean, emphasize a REIT won't do it. You need to own the real apartment buildings. You can't own the REIT. You can't own the oil company. You got to own the real oil. You got to own the gold. In fact, I've even heard some people to try to create liquidity for this event, stream the equity off of a gold company because you want to own that real asset. You don't want to own a financial asset. So let's say in 2008 at the peak, you had $1 trillion in these markets. It could be a factor of 4 to 5 times that. Now, the one thing is I doubt it's going to be long dated derivative type products like it was in the 2000s. I don't think that there's going to be a lot of demand for that depth. It's probably going to be much more near dated structures because I think you're going to end up with extremely backwardated markets. Because the one thing about the 2000s was that the capital was always looking for a home, whether if it was the excess reserves out of China, wherever it might be. And so it just went into the back end of these forward curves. It's not going to go in the back end of these forward curves right now. It's going to be spent. And when it gets spent, it creates real physical demand and creates backwardation. So these products, like you're referring to, like the Goldman Sachs Commodity Index, which is now the S&P GSCI, or like the BCom, which is the Bloomberg Index, these indices roll the front month. Though they are basically designed for this kind of environment and for that diversification. So I think there's going to be a huge demand for traded products within the commodity space, but it's not going to look the same as what it did in the 2000s. It's probably going to be much, much bigger. I mean, it's going to be far more near dated.
And I think there's also going to be far more physical, right? Because that versatility of supply chain means that actually what you're going to need, and I want to come on to the human capital element, you're going to need people who know how to secure, find, convert in time, space, and product nature these commodities to meet that demand. One thing that struck me when you were talking about oil, in fact, any of these commodities, is actually the E bit, the green bit, will actually delay our ability to invest in infrastructure to overcome this deficit, right? In terms of, for example, it's unlikely that shale, it's arguably we've had a show about this, whether, arguably it ever made anyone any money outside of the initial investors, but shale is probably not going to meet the green agenda, so that can't be a balancer for oil. You talk about the offshore drilling, that's going to be curtailed. There's going to be much higher standards put in place potentially around, where and how they drill. Same with mining. So you might actually, the capacity of the commodity industry to respond to these deficits is also going to be curtailed by the actual thing that's also driving the need.
Mm-hmm. The question is, does the demand loss from energy transition, demand loss for oil from energy transmission, outweigh the supply loss? At the beginning, you're going to get stimulus creating more demand for oil long before these technologies kill off the demand. At the same time, you're not going to get the supply. So that at the very beginning, that gap is fairly large. It becomes more ambiguous at like 2025 and then by 2023. Right now our expectations is the rate of growth slows in 2025, and the peak oil is somewhere around 2031, and then it drifts. So Rover, another way to say it is second derivative goes negative in 2025, and then the first derivative goes negative in 2031. And so when you get out there, it becomes more ambiguous which one's going to impact more. But I think you're absolutely right that the difficulty in making these investments is going to be extreme. And then you go to another question. If you were an investor today, would you invest in a deep water project? No, it's because you now know with US and China on board with energy transition, you hit the stop. This is the clock. It's ticking for oil right now. It's just a matter of time. And would I want to invest in some long-lived project? No, you're only going to do very short cycle, and you're not going to care about the growth outlook of a company like you did back in, say 2015. Instead, all you want to do is get your money back as fast as you possibly can. And you think about where does fast cycle production exist? In the United States, Middle East, in Russia. Those are the only three places that are really going to be growing production going forward. Everything else is going to be in a free fall, which means you're going to have to put more and more in that. And then also let's think about Biden. He has 3 million barrels per day of U.S. production that he can do whatever he wants on federal land unilaterally without having approval from from Congress. He can levy taxes, royalty rates. He can take away drilling credits. There's a lot that he can do in terms of creating a wellhead carbon tax, which, given the importance of that fast cycle production, there's no telling what's going to be. I think we'll have a clearer picture of what may happen in 60 days from now. But at this point right now, that's one area that he's got a lot of leverage to be able to pull around, which just even makes it that much more difficult to bring on that marginal supply that's one of the most important to the rest of the world right now.
Moving on to the human capital piece, the talent piece, I would argue, what we're seeing is that we're already certainly in the super cycle. You've had great returns across trading businesses for the last 2 years. Okay, it's been a confluence of incredible events around COVID and trade wars and so forth. I find it fascinating that, the turnaround on, unstacking a rig or reopening a mine is pretty long, but the turnaround on actually developing someone to be capable of meeting the needs of physical and financial commodity trading or whatever, merchant activities is much longer. And we've had a sustained period, actually in the case of talent, probably since the global financial crisis, when all of the banks scaled down teams, some exited. Certainly you had limited investment in new talent coming through. Then you've had the confluence as well of automation. So the traditional nursery ponds of new traders, new originators, new leaders, from operations and control and so forth. Those seats have shrunk as well. I think it's an open question how the markets, at least in the short term, and even in the medium term, are going to be able to supply the talent needed to meet the challenge presented by REV, right?
Yeah, and very much like bringing on a copper mine, it takes a long time to develop this talent. It's not something that can be generated overnight, which is why you had such extreme shortages of people in 04, 05. It wasn't until around 2011 that you really started to debottleneck, the individuals that could actually perform this. And by the time you really started seeing surplus labor in the sector, it was around 2013, 2014. So it took nearly a decade. And that's about how long it takes to bring on a copper mine. Labor is not fast cycle like the shale production is, unfortunately, which means that many of the people that did do this, going back a decade ago, they have retooled themselves, moved on to other sectors. And so trying to bring back some of that skill set would be very difficult, if not impossible, which means you're going to have to retool a whole new group of people. And this is going to take time. We go through this, and it's the boom bust cycles associated with commodities. And by the way, I would argue it's not just commodities this time, it's the whole macro space, because it's been a bear market for macro trading now for, going back to, 2014, something like that. So it's a broader whole in, people, if you look at, where did the talent go? It went into new economy, tech, and, the Googles of the world. That's where all the talent got trained up, and that's where they went. They avoided the old economy in the macro space, which means we're going to have to see a lot of people brought back into that space. So it's not just commodities. It's rates, FX, all of it, because these things all have been a sleeper for quite some time.
Yeah, there's not. In 2005, the energy trading companies were drawing from ags. They were drawing from equities, FX, bonds. Lots of the leaders in commodities right now have a background in bonds. Yeah, as you say, that pool isn't available. You've also had an aging, that the cohort that will be able to build the commodity desk of the future, are exactly the same people in many ways that were mid-level a decade ago. There's no one behind them. So I think it's going to be a real challenge, and it might be a little bit different, right? Because a lot of what we've covered as well has been that the commodity desks of the future are going to look quite different. They're going to be much more automated, much more data-driven. You've already got one person doing the role of maybe 5 people, 20 years ago in terms of, trading, origination, operations, business development. So it is going to look different, but I think it's going to be a real challenge for organizations to actually meet their strategies around building out, if not aggressive trading desks and at least marketing and origination businesses that help them get closer to their customers, closer to the edge, and manage that volatility in their supply chains.
By the way, the one thing I think that's going to make this one different than, let's say, the 2000s is that risk mitigation came through syndication or came through trading, managing the risk through trading. I would argue that this time around, mitigation of the risk is going to come through syndication of the positioning, parceling it out to, different types of counterparties. Because I think the tolerance within banks or any other organizations to be able to take on large amounts of risk are not going to be there, which means that people with the origination skills are going to be the ones that probably where the bottlenecks are going to exist.
Yeah, and that's probably going to tie into a lot of what's going on in distributed ledgers and so forth to be able to actually track these trades and distribute them really efficiently. So short term, we've probably got a bit of a wild ride. We could see oil hit some unprecedented highs. You can have a lot of volatility, demand for talent. Long term, just moving on to that long term. Okay, so it's 2025. What do you see at that point taking us through the next to the end of the decade?
The question is, if the ultimate goal here is income equality, then this thing's probably going to go on until you resolve that. And you look at what happened in the 70s, it went on until finally, price of houses were too high, interest rates were too high, people said they had enough. It wasn't that Volcker was this magician who came in there and could do it. The only person, he did it because the people wanted him to do it. And so the question is, when does this thing end? It probably ends when people think, hey, we've taken this thing too far. I don't know. Is that 5 years from now? Is it 10 years from now? Somebody made they asked me, well, can't you just be like MBS, take everybody to the Ritz-Carlton and shake them down? Yeah, you could do that. But by the way, you're going to get the same outcome of a bull market in commodities. Why? Because they just walk out the next day and spend all this stuff and the prices would explode. So you still end up with that same bull market and commodities kind of inflationary backdrop, even if you did it that way. So it doesn't matter the way you do it. You still end up with the same outcome. The question is, how long does it take to do it? And so, I can give you different scenarios, and I have no idea which one's going to be the one that's going to be executed on and the one that's the most dominant here. We'll find that out as by 2025, we'll probably have a clearer picture. But I would view that as being, when do we think this is over? It's when everybody thinks the world has had enough of trying to achieve income, equality. Because I think the point right now, we've all had enough of achieving financial stability. It was, it had a lot of pitfalls in it that we now know, but at the time, people were focused and policy was focused on that financial stability. Now it's focused on social need. And so the question is, when do we think we have enough of that? And I think, what measures of inequality might be the way to look at it.
Yeah, there's a couple of, I want to pick out one or two or three, I think, key things I've taken from our discussions that, you can almost be pretty confident on. One is inflation. Can you talk about where that's going to fit in this and how that's probably going to exacerbate problems?
Again, I'm not the macroeconomist, so I don't, I'm not the one with the inflation view here, but I just want to talk about broadly. And by the way, if we're talking inflation, it doesn't take much to create a problem. If your average bond yield of an investment grade portfolio is 1.95%, you go to 2%, you got a problem. But let's talk about, historically, solving income inequality. Why is it correlated to inflation? It's not the policy goal. The policy goal is income equality. When do wages converge? Wages converge in an overheating economy. We have not seen an overheating economy. We saw it briefly in late 17, early 18, and then they raised rates to 2.5% and killed the golden goose before it could lay an egg. In terms of before that, we saw it briefly in, 6 and 7, the 2006 and 7. So we haven't seen overheating economies for very, very long periods of time. And that's part of the reason we haven't seen a bull market in commodities or inflation in a long period of time. So if you make the observation that wages converge in an overheating economy, policymakers want to see converged wages, means they're going to let this thing overheat. If they let it overheat, the byproduct of an overheating economy is our commodity bull markets and inflation. I'm not trying to take a view here on inflation or commodity, but I'm just making that simple observation is that if you want to create income equality, best way to do it is let the economy overheat because, all boats rise in the rising tide type scenario. And so the byproduct of that environment is inflation in commodity bull markets. That's kind of the way I would think about it, which goes to that whole point that I was saying before is the place we were most equal historically was that period in which we had peak inflation and peak real commodity prices.
The other thing that really struck me from our conversations was you said metals is going to be the most interesting thing in a decade, or the most interesting traded market. I found that fascinating. Can you give us a insight into why?
If you take copper, there's no way you can do the energy transition with that. And the potential demand from this is massive. And when we also think about your today, inventories in the last 5 weeks on copper have drawn is the largest observable draw for this time of year. Inventories are at '08 levels. Prices are at super cycle levels, and we haven't even started the energy transition. And there is no technological substitute for copper. And so, you listen to people that say, oh, the beauty about renewable power and everything is we don't have to depend upon rogue states for oil production. And I mean, my point is that no, you're just going to trade, geopolitical issues with oil producers for geopolitical issues with metals producers. You can't do this energy transition without copper. Last time I checked, China, Europe, or the United States don't produce copper. And copper is the most critical input to creating this energy transition. You need to have cobalt, you need to have lithium, you need to have nickel. All of these metals start to become strategically really important. And also the group that, so does Chile become the new Saudi Arabia? By the way, it doesn't take long. For those all of us, that have been in this business for quite time, energy was always the elephant in the room, while metals was its, energy's poor stepchild. It's going to reverse. But think about this. All you need is copper to go to 30 or 40,000 a ton, which would be, let's say we know oil was, the gorilla in the room during the 2000s, and oil went from 20 to, call it 100, went up a quintuple. Let copper do that. Oil goes up to, let's say, 85 or 100 and stays there. Copper goes up by a factor of 5. Now metals are bigger than energy, and we're in a very different world where energy now becomes the poor stepchild of metals, and Chile is the new Saudi Arabia, and guess what? That new rogue state is the DRC. So it's I'm not forecasting this again. These are the things we need to be thinking about. That could really shift here because strategically metals become far more important than oil and energy and the fossil fuels, because ultimately aren't we trying to get away from fossil fuels and go to electrification? So anything that can create electrification becomes strategically important. And copper still, given the constraints around the periodic table, becomes the strategically most important commodity.
Yeah, I mean, if electrons go to a variable cost of zero, right, through renewables and so forth, yeah, I mean, I think it's an obvious, well, an obvious outcome. So you've got inflation, well, potentially have inflation. You've got this coming macro shift in prices in the commodities, which will be a fun event when it happens. Long term, you're still, as you say, there are going to be critical components to this energy transition, $16 trillion going into it, that are currently in deficits, and there's going to take a significant amount of investment to meet that coming and new demand. What else should we be looking out for over the long term?
I think the long-term outlook is thinking about the energy transition and how quickly it can happen before you start to have much more deleterious impacts of not doing it. Because if we get to a point where we're forced to do this very, very quickly, by the way, I'm not going to discount that. Rolling out EVs and electrifying the world is not going to be an option. And it would have to be done, similar to carbon removal or one of these, I still think, that the carbon capture is going to play a role, even with this more public-private partnership we've been talking about, particularly in the production of hydrogen and other types of industrial activities. But if we got into a situation where we have to deal with climate change immediately, and let's say it's like COVID, where we're watching 5 pharmaceutical firms duking it out for a vaccination. And by the way, we've proven don't bet against human ingenuity in dealing with these crises. And where backs are against the wall, and you got to come up with a carbon removal process to just abate the atmosphere. And by the way, I'm not going to dismiss that as a low probability. Man, we don't know enough. All I know is we completely underestimated COVID. What are the odds we're completely underestimating climate change? If you get one of those outcomes, that creates a very different world. Oil still retains a position that is, because you've now dealt with the carbon issue. So that's the one thing that I would just keep on the radar screen is, what is the potential of having to deal with this climate change issue in a much more urgent manner, more quickly than what everybody has planned out, this 2050 or 2060 type target. And if we're in that, what does that mean for commodities? What it means is, there is a future for oil, because you're going to have to just figure out how to abate this stuff.
Yeah, this is I think what I found fascinating about electric vehicles from the podcast we did with Arkady Sozanov of FreeWire Technologies is that, people are buying EVs because they like, right? This isn't government sponsored or driven by that. But the issue is that the scalability for us all to have EVs globally is just, it's mind-boggling. Even at this stage, there's very little penetration right now, and there's already, crunches on lithium or whatever it might be. And I guess you're using the analogy of the catalytic converter, that actually, someone could invent something that just captures the carbon at the tailpipe, and we'll all carry on with combustion engines for a while. So there's still a lot of uncertainty about where this might all go. Well, it's been an absolutely fascinating discussion, Jeff. I've really enjoyed it, and it's given a real insight and some part excitement, part fear about the future.
Great, Paul. Thanks for having me here.
Thank you for listening. If you enjoyed this episode and want to support the show, please give us a positive review on Apple Podcasts or Spotify. To find out more about HC Insider and Human Capital, a search firm dedicated to the commodities sector, go to www.hcinsider.global, where you'll find more original content on the commodities sector and more details on our offering as a search firm and our locations around the world. Thanks again for listening.